All right, hey, welcome back to Principles of Accounting 1. It's been like forever since I feel like I've been with y'all. I apologize for all these weeks that have gone by. I don't even know how many weeks it's been, to be honest. Last week I had a conference. A week before that, I think we had a was it the midterm? I don't even know. There's something going on then. I forgot what it was. I think it was the midterm. Anyway, happy to be back with you. So again, once again, apologize for the time away. Wanted to call your attention quickly to the classroom, just kind of let you know where we are, where we're heading, all of that important stuff that we need to know. So here we're already in week 11, which is pretty impressive. I mean, it's the time goes by so fast, doesn't it? It just feels like it flies by. Um, This week, we're going to be talking about current liabilities and payroll, which is a really fun topic, in my opinion. I'm not going to explain why, because payroll affects all of us, and it's important that you understand how to read your paycheck. Oftentimes I've had students come to me and say, "Hey, Dr. B, I just got my paycheck, and there's all these things going on with it, and I really don't get it because, it's like, oh, I get paid 20 bucks an hour. I work 40 hours a week, so I would expect it to be that would be in my check, but it's not. It's less than that. Can you explain why? And it's like, well, there's the federal taxes, the state taxes, the Medicare, Medicaid, the Social Security tax, and maybe you might have some other deductions, pre-tax deductions like um, retirement fund or something like that, right? So there's always reasons why the pay is always different than what your gross pay is always different than your net paid. So that's why I like this topic a lot. I think it's very useful for you, and I'm going to try to make everything as relatable as possible as we go through today's discussion. So I'm going to go ahead and open up the PowerPoint presentation now for week 11. So let's go ahead and jump into it and have a little bit of fun. All right. So for today, we're going to talk about current and long-term liabilities. Remember, a liability is anything that we owe to someone else. So a liability is anything that we owe to someone else. So we have current liabilities, which are payments that are due within 12 months or less. And we have long-term liabilities, which are obligations that we have that are longer than 12 months. So current, 12 months or less, long-term, longer than 12 months. So we'll talk about those liabilities. We'll talk about how we identify them, how we describe them. We'll talk about contingent liabilities. We'll definitely talk about payroll, real fun stuff there. And of course, we'll do some calculations with some ratios. And that'll be it. It'll be nice and easy kind of going lecture today. So again, if you have any questions along the way, feel free to open up your mic and ask your question, or if you want to type it in the chat or anything like that, it's totally fine. So again, appreciate you all being here today. So let's talk about liabilities and the difference between current and long-term liabilities. Now remember, a liability is anything that we owe to someone else. That's what makes it a liability, right? Anything we owe to someone else. So a liability is a probable future payment of cash, really, or services that a company is currently obligated uh, to pay as a result of something that has happened in the past. So examples of this, I've received my Pepco bill for electric um, a few days ago, and it was for the month of October. Well, October obviously already happened, and so I received the bill for the month of October. I received it a few days ago. We're currently in November. So that bill represents the transaction, which is the consumption of electricity that has happened in the past. right? Last month. So that bill is an obligation to me. It's a liability to me. I owe it, right? It is currently due. It's due within the next 30 days. So it is a current liability. It's a result of a past transaction. Uh, and sometimes we have to pay it right away when we receive the bill, or we sometimes pay in the future, but like 30 days from now, thereabouts. But either way, that's what makes it a current liability. If it's something that we owe in a year from now, let's say it's like a long-term loan that we took out from the bank for, let's say, for a mortgage, car payment, whatever. It's something that we owe greater than 12 months, then it's a long-term liability. But either way, a liability represents that we owe money to somebody else for some reason. Yeah. So, as I mentioned, the liability will either be classified as current or long term. Current liability means that it's due within 12 months or less, and a long term liability represents it's due greater than 1 year. Current liabilities represent those bills, those current bills that we've received. Now, those bills, as you know, belong to an account called accounts payable. I received my Pepco bill, haven't paid it yet. It's an account payable, right? And it represents the electric expense, and I haven't paid it yet, so it's an account payable. Current liabilities also include things like the short-term notes payable. This is like a short-term loan that sometimes companies will take out from the bank in order to cover some type of short-term expense, right? We call those short-term notes payable. It's a short-term loan. Current liabilities also include things like wages payable. This is when my employee worked for me for 2 weeks and I haven't paid them yet. That creates what we call a wages payable. And I'm going to pay them, obviously, within 12 months or less. And it's called wages payable. It's what happens when the employee works. They accrue the wage and we have not yet paid it. Wages payable. So that's another current liability. Some things that companies offer called warranties is a liability for the company. A warranty is like you purchased a new electronic device, let's say a new phone or a new television set or a new computer or whatever. Oftentimes, those will come with what we call a manufacturer's warranty, and it's something goes wrong with it within the 12 months or less, the company will repair or replace the device, right? It's called a manufacturer's warranty. And for the company, that's a liability, obviously, because there's a possibility that somebody might claim that warranty. And so therefore, it's something that it's an obligation that the company must fulfill. And therefore, we classify warranties as a liability for the company. Another current liability that most companies have and individuals have is called taxes payable. Taxes payable are generated by sales tax, so it'd be sales tax payable or income tax payable for individuals, right? So we have taxes payable that is a current liability. And then another example of a current liability would be unearned revenue. Now, it's important to remember that with revenue, it becomes revenue when it's earned, when we have delivered the good or the service. That's earned revenue. That's just regular revenue is when we have delivered the good or the service to the customer. If a customer pays us before we deliver the good or the service, that's called unearned revenue, and that's a liability to the company. The reason why it's a liability to the company is because the customer could always say, "Hey, you know what? I don't need you to deliver the good or the service. I'd like a refund." That's why it's a liability to us. So we've unearned revenue is when the customer pays the company before we deliver the good or the service. It's unearned because we have not yet performed the good or the service. It becomes earned when we deliver the good or the service. It's a liability because the customer could always request a refund before we deliver the good or the service. So those are current liabilities. Moving on to long-term liabilities, these are liabilities that are due after 1 year, so longer than 12 months. These typically involve things like long-term notes payable. An example of a long-term note payable would be a car loan or a mortgage. It includes other warranty liabilities like if the manufacturer's warranty is greater than 1 year, let's say it's a 2 or 3 year manufacturer's warranty, that would be considered a long-term warranty, and that's a long-term liability. Long-term liabilities also include things like leases. Oftentimes, you might engage in a lease contract that is greater than 1 year. For example, I was renting an apartment in Germantown, Maryland, and when I was renting that apartment, I engaged with the landlord for a 2 year lease. And so, obviously, to me, that's a long-term liability, right? Because I have to pay that for 2 full years. So anything greater than 1 year is long term. And so this is a lease liability that is greater than 1 year. And another example of long-term liability is a bond payable. Bonds are similar to stocks, but except with bonds, a bond is kind of like when a company purchases or pays out a bond. What's happening here is that somebody like you or I will purchase a bond from, let's say, a local government or from a company, and the company will have to pay not only the face value of that bond, but also interest, and they'll pay that out over a long period of time. So a lot of bonds are considered long term. You'll see that on the balance sheet of any company under liabilities, you'll see current liabilities and long-term liabilities, and they're separated out. We call that a classified balance sheet. So next, I'm going to show you just quickly some other examples of current liabilities as a percentage of total liabilities. Remember, current liabilities being due within 12 months or less. So here are a couple of very well-known companies, Tesla, Caterpillar, Meta, and Six Flags. We can see that Tesla's current liabilities makes up 67% of their total liabilities, which is super, super high. That makes me nervous as a potential investor. But at the same time, it's important that we understand what their business model is like. Here with a company like Tesla, they probably have a lot of bills that they owe to their vendors, which makes sense as to why their current liabilities would be so high. Caterpillar, 51% of their current liabilities makes up their total liabilities. Again, maybe a little high, but at the same time, we need to understand their business model. And then we see Meta and Six Flags, very typical percentages for these types of companies. But just to kind of give you an idea of what current liabilities makes up of the total liabilities for various companies and industries. Uh, Sometimes we might not know exactly um, if it's a liability or not. What I mean by that is sometimes there's uncertain elements to a bill that we receive. It might say statement on it. And is a statement the same as a bill? Maybe. It depends. It depends. It depends on a couple of things. We have to know more information. If we know who the we owe the money to, then yeah, it's probably a bill. If we know when it's due, does it say due now? Does it say due on a certain date? Does it say due in 30 days? That's something we need to know. That's a characteristic of a bill. And then how much to pay is another question as well. Um, Sometimes we don't know one of these factors, right? I'll give you an example of this. If you receive a bill from your vendor and it says something like this, it has credit terms. Remember, we talked about credit terms? Let's say the bill has credit terms on it. Okay, you got a bill from your vendor. Your vendor says, "Hey, listen, um, you owe me $100 from your most recent purchase, and it's due within 30 days. However, if you decide to take advantage of the credit terms, it'll be due in 10 days. So let's say it's a 210 net 30 credit term. That means if that I'll receive a 2% discount on the $100 that I owe if I pay it within the first 10 days. Otherwise, the whole amount's due within 30 days. Now, what that does is it creates some questions as to when the bill is actually due, if I pay it within 10 days or 30 days, and how much I have to pay, right? If I take advantage of the 2% discount within the first 10 days, otherwise the whole month's due within 30 days, that means I would only pay, 90 to $96 instead of the 100, right? So something to be aware of. Yeah, so it's important that we have some certainty in how much we're paying and when we're paying it. So let's talk about some of those liabilities that I had mentioned earlier when we talked about short-term and long-term liabilities. Uh, I want to dive a little bit deep into these ones. We already know what accounts payables are. That's when we've received the bill from our vendor or one of our many bills that we receive for doing business, and we haven't paid it yet. That's called an account payable, right? Sales taxes. Sales tax payable, very typical. If we're in the business of selling inventory, we collect sales tax from our customers. We have to pay that sales tax to the sales tax agency, right? So it's something I haven't paid yet. It's a liability. Unearned revenue, that's when I've made, when a customer has paid me before I have delivered the good or the service. That's called unearned revenue. It becomes earned revenue when we deliver the good or the service. So therefore, it's a liability to the company. Notes payable, these are the same things as loans from the bank. This could be a short-term or long-term loan, depending on the type of loan that it is. Payroll obligations. I need to pay my employees. I need to pay payroll taxes. I need to pay payroll expenses. These are all payables, so payroll obligations. And then what we call multi-period known liabilities. These are like long-term loans, like a mortgage or a lease. Yep. So these are all known liabilities. So we're going to talk about some of these a little bit more. So one of the first ones I like to talk about is sales taxes. Very, very common sales tax, right? If in retail, there's always sales tax. Like for example, you went to the corner store the other day, you bought $30 worth of stuff. The total on the register rang up as $30, $36. The $6 is taxes, right? So the total was 30, it rang up as 36. The $6 is taxes. So the shop keeps that $6 and then hangs on to it for a month and then remits it to the sales tax agency, right? That's called sales tax payable. Here I have an example on this slide here. If Home Depot sells materials August 31 for $6,000 in cash, the sale is subject to a 5% sales tax. The revenue portion of the transaction is recorded here. Uh, and so as you can see, the transaction looks like this. The customer ended up paying Home Depot $6,300 total. So they debit cash for 6,300. They credit the sale of the inventory 6,000. The difference is the tax. So to find sales tax payable, it's very simple. We just take the total amount of the sale and we multiply that by the sales tax rate. In this case, 5%. So 6,000 times 0.05, which is 5%. We find 300 bucks is the sales tax. So we debit cash, credit sales, and credit sales tax payable. So that's a nice example of sales tax payable. The next one that I like to talk about is called unearned revenue. This is also known as deferred revenue. This is the amount we've received from our customer in advance of us delivering the good or the service. Examples of this would include something like airline ticket sales, magazine subscriptions, construction projects, hotel reservations, gift card sales, um, and maybe when you purchase something on Amazon and it hasn't shipped yet, that's unearned revenue for Amazon. Okay. So there's some examples to name a few. Eventually, obviously, these will become earned revenue when the good or the service is delivered. So when you take that flight, when you stay at that hotel, when you receive the magazine subscription, when you build that house, when you use that gift card, etc. We recognize revenue when the good or the service has been delivered. It's unearned revenue if the good or service has not yet been delivered. So here we have an example. Selena Gomez sells $900,000 in ticket sales for 3 concerts. So she's got to make some entries on her books, and so it looks like this. So June 30, she received the cash for the concerts she has not yet performed. So the first thing she does is she debits cash 900,000 and then credits unearned ticket revenue 900,000. Then when she goes to perform her first concert, she needs to recognize revenue at the end of that concert. And so I imagine her accountant would debit unearned ticket revenue and credit revenue. Now you'll notice that it's for 300,000, not for the full 900. The reason being is because the 900,000 represents 3 concerts. She's only performed one so far. So at the end of that first concert, it's 300,000 in revenue that she recognizes. So it's 900,000 times 0.1/3 or 0.33, which is 1/3. Yep. So that's how we got that. I like that example. That was good. All right. So the next thing I'd like to talk about with respect to current liabilities is short-term notes payable. Now, as the name implies, this is a short-term loan. that the company got from a bank. Very common that a company would get a short-term loan from a bank to cover some type of short-term obligation. Yeah, very, very normal. Or one of my favorite examples, I had this one customer one time in my consulting business. This guy, man, I tell you, he was hard to find. So what happened was I provided consulting services for this one customer, one client of mine, and I sent him the invoice, uh, and I said, "Hey, it's due within 30 days." So 30 days goes by, and surprise, surprise, the guy didn't pay. So I'm like, okay, whatever. So I got a little upset. So I sent a love note to him and said, hey, uh, you owe me some money. Pay up now. It's freaking late. So um, another 30 days goes by, still doesn't pay. Okay. You know, Dr. B normally doesn't get upset, but I was upset with this customer, this client. So 60 days, no payment. So then I send another notice. 60, 60 days past due, pay now. Another 30 days goes by. Now we're talking 90 days. Okay. No, this guy didn't pay. So I get upset, right? So then, I may have paid him a visit. I may have brought a baseball bat with me. I can't confirm or deny that, but I paid him a visit. And I says, hey, listen, you're like half a year past due. Um, you're either going to pay me now, or I'm going to move your account payable into a note. I'm sorry, your account receivable into a note receivable, meaning you're going to pay me plus interest, right? So I think I told you that story before, but I brought it up again because the same thing works with payables, right? Let's say we fell behind in our bills with one of our vendors. This happened to me before too, actually. Well, it happened in the hotel, not to me directly. So when I was working for Radisson Hotels, we have a huge vendor called Cisco. Cisco, they deliver a lot of different things like food, linens, you name it, they deliver it. Okay. We at one time we owed Cisco like $400,000. All right. And they're a huge, huge account. So my people in accounts payable, we had a problem keeping up with this account. So they came knocking, and they're like, "Hey, listen, Dr. B, you guys got to get current with us. So what we're going to do is we're going to transfer part of your account payable into a note payable." And so it's like, okay, so there's interest associated with that. So that's what a short-term note payable is. Yeah. So it's a result of either short-term borrowing or the conversion of an account payable into a note payable. So here we have an example of that type of conversion of an account payable into a note payable. So our company, uh, so our vendor asked our company to convert the payable. Okay, so we asked our vendor to convert our account payable into note payable. So we said, hey, listen, we'll give you $100 in cash now, and the rest 60 days later with a 12% interest rate on a $500 note. Okay, so what this does is it converts the $600 account payable into a note payable, right? That bears interest. So the transaction looks like this. We debit the account payable for 600. We credit cash 100 because we said we would pay them 100 up front. And the rest of it we convert to a note payable. So we credit notes payable. So the 60 days goes by and then we got to pay them, right? So here we are paying them on that transaction. So 60 days later, we debit the note payable for 500. We debit interest expense, and then we credit the cash. The interest in this case is $10. Now, here you see down below, this is called the interest expense formula. The interest expense formula. And it works like this. We take the balance or the principal amount of the loan, principal amount of the loan. We multiply that by the interest rate, and then we multiply that by time. Time is can be expressed in days or months. Okay. In this case, you'll notice that it's in days and it's over 360 days, not 365 days. The reason for that is because there are only 360 banking days in a year. Okay. So that's how we express it. The other way you can express this is in months. So 2 out of 12. So 2 over 12 is 2 months. Yep. Either way, you'll derive the same response. So principal amount times interest rate times time. In this case, $10. So we debit notes payable, debit the interest expense, and credit the cash to pay the note. So that's if we had a conversion of an account payable into a note payable. Next, I'd like to show you a note payable that stems from a loan from the bank. So very, very similar in nature. So we took out a short-term loan from the bank to cover some expenses. So September 30, we took out the loan for $2,000. It's a 12% interest, 60-day note. So we received the cash from the bank, debit cash, credit notes payable. Okay, simple. The next transaction represents the payment of that note. So we debit notes payable, debit the interest expense, and credit cash. Now, once again, the way we calculate the interest expense, principal amount times interest times time. So $2,000 times 0.12 times 2 over 12 or 60 over 360, right? They both be the same. In this case, $40. So the total payment in this case is 2040. So that's an example of a short-term note payable. Now, sometimes I will tell you that the dates don't always line up easily. So, for example, if I took out a loan, let's say it's for 2 months, and I took it out in December, it crosses over into the next year, right? So at the end of that year, end of that first year, I need to make an adjusting entry to reflect the interest that has accrued during that year. And that's due to the matching principle. Yep. So so that happens as well. So here we have that example. So let's say we borrowed that $2,000, but it was executed on December 16th, 2027, and it covers 60 days. It matures or is due on February 14th, 2028. Okay. The company's fiscal year ends December 31. So therefore, we need to accrue the interest for that 15 days in December. Okay, no problem. It's pretty easy to do. We follow the same exact formula. So we take the face value of the loan times the interest rate times time. In this case, 15 days. So 15 days over 360 banking days in the year gives us an interest rate of 10, interest expense of 10. So in this case, we debit interest expense, credit interest payable $10. That's accruing the interest expense for that year, right? Because year ends December 31. for this company's fiscal year. And so therefore it falls in a different time period, different fiscal period. So then when the loan matures on February 14, we debit the rest of the interest expense, in this case, $30. We debit the interest payable that we accrued in the prior accounting period. We debit the note payable for the face value of the 2000, and then we credit cash 2040. Right? So if you needed to calculate the remaining interest expense, once again, you just use the same formula. So face value times the interest rate times time, in this case, 45 days, because we already accrued 15 of it. Okay, so that's notes payable. Very, very straightforward. The next thing I'd like to talk about is payroll, one of my favorite topics because it affects all of us. A payroll liability comes from when the employee works, but we have not yet paid the employee. Okay? Employee works, they receive wages, benefits, we have to collect their payroll taxes, etc. Yep, simple. That's payroll liability. So let's take a look at this from your perspective of what it looks like on your paycheck. Okay? So we start with what we call gross pay. This is your hourly rate times the number of hours that you've worked. Hourly rate times the number of hours that you've worked. That's gross pay. That's before any type of deductions occur. Okay? So hourly rate times the number of hours you've worked, that's your gross pay. Then we have all of these things coming out of our paychecks. Okay? Social Security tax. Well, first we have voluntary deductions. Voluntary deductions are pre-tax. These typically include things like retirement funds, like a 401k, maybe a health savings account, or maybe, some type of child support or whatever, something that comes up pre-tax. Okay? So gross pay minus your pre-tax deductions, like 401k, retirement contributions, um, maybe you do charitable giving or whatever before tax. You know? So gross pay minus pre-tax, and then come the taxes. First will come the Social Security tax. I'm sorry. First comes the federal tax. Then comes the state and local tax. Then comes the Social Security tax and the Medicare tax. Okay? Then at the very bottom of the paycheck is what is actually deposited into your bank account. That's called your net pay, also known as take home pay. So that's how it works. That's how your paycheck works. Now, it's important to note the taxes, okay? So for you, the employee, you have to pay a portion of Social Security tax and Medicare tax. Social Security tax is taxed at 6.2% up to the first $168,600 that you earn in the year. You also have to pay Medicare tax. This is so when you get older, this acts as your health insurance, right? So that is currently paid at 1.45% of your total earnings. Okay, so those come out of your paycheck. Now, it's also important to know that your employer has to match these contributions, and I'm going to explain what that looks like. But so your employer holds on to these out of your paycheck and then remits them to the IRS uh, pretty much once a month or once every 3 months. Okay. You, of course, obviously have to pay federal tax and state tax These are held uh, taxes based off of your tax bracket that you fall into, depending on your gross wage. So your gross pay determines what tax bracket you fall into. And so the tax brackets change every year by a little bit, so it's important to always keep an eye on that. It's usually a percentage of your gross pay. So it might be like anywhere from 12% all the way up to, I think the highest tax bracket I think is at 32%, something like that. I forget. It might be higher than that. So either way, your employer withholds these taxes and remits them to both the federal, state, and local agencies. Employees also have voluntary deductions. These are typically pre-tax, so before any taxes are withheld. These include things like charitable giving, uh, health savings accounts, insurance accounts, retirement, union dues, uh, and then any other type of garnishments for wages. So your employer also has to pay tax on their side, which we're going to talk about here shortly. But I wanted to first show you what it looks like on the accounting side. So this is what a typical transaction looks like for each employee every 2 weeks. So the first thing we do is we debit the gross pay. So debit salaries expense for the employee's gross pay amount. In this case, $2,000 in this example. Then we credit all of the deductions. Okay, so first thing we credit Social Security tax at 6.2%, Medicare tax 1.45%, employee federal income tax, the medical insurance payable, union dues payable, and then what's left over is the net pay, which is salaries payable. So you take that 2,000, you multiply that by the 6.2% to get Social Security, the 2,000 times 1.45% to get Medicare, and then the others are based off of the brackets, but you subtract all of those out from the 2,000, you get to 1,524 bucks. And then when we pay the employee the next day, we debit salaries payable and credit cash. So this is what payroll accountants do. This is pretty much their job. Yep. Okay, so now let me show you what employers have to pay. So you don't have to pay these, but your employer does. So the employer has to match your Social Security tax and your Medicare tax. But what the employer also has to pay is called unemployment tax. Now, unemployment tax happens when, in the event that an employee becomes unemployed for no fault of their own. We call this unemployment insurance. Okay. So if you've ever worked a job and you've been laid off or you've been terminated or the job was eliminated for cause without, in other words, you didn't make a mistake, right? Then you're eligible typically for unemployment insurance. And so you'll apply for unemployment insurance through your local jurisdiction, and you'll receive a payment once a week or whatever it is, right? You might have wondered, where does that money come from? Well, it comes from your employer. Your employer's been contributing certain amounts. And I'm going to show you what those look like. So your employer contributes for federal unemployment tax 6% of the first $7,000 of your wages, and then it goes down to 5.4% thereafter. Um, that's federal unemployment tax. The other one is the state unemployment tax, and that's at 5.4% for the first 7,000. And then it goes down a little bit thereafter. So very, very typical. But these are what your employer pays. This is more or less of a benefit for you if you ever become unemployed. So the employer has to record these as well, and so we do those through journal entries. So at the end of each month, we debit the payroll tax expense, and we credit the Social Security tax payable, Medicare tax payable, state unemployment tax payable, and federal unemployment tax payable for each employee. Where we got the rates is we take the gross salary amount and we multiply that by the respective percentages. And that's how payroll accounting works. Yeah. Yeah. Very straightforward. It's kind of boring, to be honest. I've always thought that payroll accounting was always boring, but that's just me. I'm not too sure how you feel about it, but that's how I feel about it. So I'm going to talk a little bit more, just a little bit more about payroll, and then we'll move on to multiple year or long-term liabilities. So with payroll, there's four key areas that should have separated duties. We talked very early on in class, maybe the first week, we talked about the importance of separating duties for a system of internal controls. It's really important that every company has a good set of internal controls, and one of those is separating the duties when it comes to payroll. Um, so, for example, human resources is responsible for the hiring and firing and training of employees. That's a separate duty. Uh, so, whoever does payroll is that's totally separate from who does hiring, firing, and all that jazz. Payroll preparation is done by one accountant. The timekeeping is done by the time clock, so you punch in and out for your shift, or you track your time somehow accordingly. And then the payroll is dispersed. But you'll notice that there's checks and balances along the way. This is to ensure that there's no fraud occurring within payroll. So that's payroll in a general sense. The next thing I'd like to talk about are uh, multiple or long-term liabilities, very briefly. Uh, these can include unearned revenues and notes payable, and multiple periods or multiple months or multiple years. An example I like to use is Microsoft. They sell a 3-year subscription for the Xbox Game Pass. And because it's multiple accounting periods for multiple years, they classify that as unearned revenue until the gamer uses the Game Pass, or if the month goes by. After the month goes by, we recognize it as revenue. Yep. So that it's multiple years. So in this case, we recognize the revenue at the end of each month as it's being utilized. Yep. Very simple. Or you do it all at the end of the first year. It all depends on the type of agreement. So this is one example of long-term liabilities. The next thing I'd like to do is talk about what we call estimated liabilities. If something is probable, meaning there's a good chance of something happening, we estimate it. If it's probable, we estimate it. If it's not probable, meaning very low chance of something happening, then we just disclose it in the financial statements as notes. But if something is definitely probable, meaning yes, there's a good chance that this will happen, then we estimate the liability. Examples of these would include things like pensions, which are retirement plans, healthcare benefits, vacation pay, and other warranties. So if it's probable, we estimate it. If it's not probable, we just disclose it in the notes. Let's roll through a couple of examples of this. Here we have employee health and pension or retirement benefits. We assume that an employer agrees to pay an amount for medical insurance equal to $8,000 and contributes an additional 10,000. I'm sorry, 10,000. Yeah, that'd be nice. 10% of the employee's $120,000 gross salary to a retirement program. Okay, nice benefits. Very good. So in this, the way that that works is we would debit employee benefits expense, 20, $20,000, which equals the 8,000 for the medical insurance plus the 12,000 for the retirement benefit. 120,000 times 10% is 12. So we debit employee benefits expense, credit the employee medical insurance program, and credit the employee retirement benefit program as payables. Yeah. So that's an example of employee health and pension benefits. Then we have vacation benefits. This is super common, obviously. Employees need to take vacation time. I'm always a big fan of taking a little bit of time off here and there for your mental sanity. So don't forget to use your vacation time, okay? I need you all to take a little bit of time for yourself. Okay, so vacation time. We assume an employee earns 2 weeks of paid vacation in each year. That's pretty nice plan in my opinion. So we record the transaction like this at the end of each year for each employee. We debit vacation benefits expense, 3,200, and credit the vacation benefits payable, 3,200. This is based off of their salary. Then let's say an employee takes a day off or so. We would debit vacation benefits payable and credit cash to represent that day off or week off or whatever it was. So keep in mind that these are estimated amounts, right? We estimate the amounts because we don't know if the employee is actually going to take vacation. We hope they do, but it's up to them to take it. So, but we have to estimate it and accrue it as a liability because there's a good chance the employee's going to take it. Yeah. Here's another one. Bonuses. Some of you might be fortunate enough to work for a company that offers bonuses to their employees. That's awesome. This is in addition to their income. And so this is an example of a bonus that's being shared by multiple employees. We have this bonus here, $10,000. So we debit employee bonus expense and credit bonus payable. Yep. Just another nice thing that sometimes employers do for their employees. I'm looking at you, UDC. Come on, pay up. Well, you're supposed to laugh at that. That's funny. All right. Um, Warranties. Let's talk about warranties. Warranties represent the expectation that sometimes when you buy a brand new product or a service, that it'll break down. It won't work. Something goes wrong with it within the first year or two, okay? Or three. Yeah, life happens. What can I tell you? Sometimes you get a defective product, right? Warranties. A lot of new cars have warranties. A lot of new appliances, like a dishwasher, has warranties. Electronics, like a computer, a smartphone, they have warranties. Very, very common. Yeah. There's an expectation that, hey, uh, sometimes there might be a percentage that will be defective or whatever, and will need a repair or replace. And so we need to estimate that. And a lot of times these estimates are done off of historical data, what has happened in the past. So here's an example of this. Here we have a car dealership that sells cars. They sold a car for 80 grand with a maximum 1 year or 12,000 mile warranty that covers parts. Based off of the dealership's experience, about 4% of the car's sales price will be claimed in warranties. Now that's the estimate. Okay. So we record the estimate like this. We debit warranty expense 3,200, which is 4% of the $80,000 sale price. And then we credit estimated warranty liability. So just in case, right? 4% of the sale price might be covered in warranty. Then luck has it, um, the customer came in wow, this is bad. The next month because yeah, there was a defect. Something went wrong here. So the dealership has to replace a car part that cost 900 bucks. So they debit estimated warranty liability and they credit their parts inventory for the repair. Yeah. So that's just an example of how warranty accounting works. The next thing I'd like to talk about is contingencies. I had mentioned earlier that it's important that we understand when to estimate. And when we estimate, it has to be because something is probable, meaning there's a good chance of something happening. And if there's a good chance of something happening, we need to estimate that expense, like a warranty claim or whatever. Okay. If it's if it's probable, but we think that it's something that we cannot estimate, then we just disclose it. If there's a slight possibility of something happening, like a lawsuit or something, ridiculous, that's very low chance of something happening, but it's possible, we just disclose it in the financial statements as a note. If there's no chance of something happening, like, hey, you know what, that's just very, very unlikely, we don't disclose it. We don't do anything with it. We just send it on its way. So, so that's what we mean by contingent liabilities. It's the potential obligation of a future event occurring based off of a past transaction. So we need to understand if something's reasonably possible in order for us to consider it to be a contingent liability. Um, if it's possible and it's probable, then yeah, we need to estimate that. If it's not, then we need to at least disclose it. So here we have potential legal claims. If it's possible and probable, then we estimate. Debt guarantees, um, these are disclosed in the financial statements. Other contingencies, it depends if it's substantial. If it's substantial, we estimate it. If it's not, then we just disclose it in the notes. It's also important that we understand uncertainties. Every company obviously faces some type of uncertainty of a future event happening, like a natural disaster or artificial intelligence causing some chaos. These uncertainties are not considered to be contingent liabilities because they're unknown and they're not a result of a past transaction. They're a result of something that might happen in the future. So we don't even disclose this type of thing. So just want to let you know that. All right. So we've made our way to a couple of ratios that we should know about. One of these ratios is called the times interest earned ratio. Uh, This is typically seen as a fixed expense because interest expense is typically viewed as a fixed expense because it's not a result of short-term changes, right? it has everything to do with a company's riskiness. All right. So we calculate this to really understand the company's risk as a result of some short-term borrowings. And it tells me about how many times the company can repay interest on their liabilities. So the way we calculate that is we take the income before interest, expense, and income tax, also known as operating income, and we divide that by interest expense. Both of these line items are found on the income statement of the company. And here I have an example of that. For Diego Company, we can see here their an abbreviated version of their income statement: sales minus their expenses, et cetera, et cetera, et cetera. So we're just plugging in the information. So 150 million of income before interest and taxes, divided by their interest expense, in this case $60, tells me that they can pay their interest 2.5 times. Um, and so that tells me that there's some risk here, but it's not very high. And then I wanted to just briefly talk a little bit more about payroll, because I find this one to be pretty important, and all of you are affected by payroll at some point. There's a bunch of forms floating around out there when you first get hired on. When you first get hired on, you fill out what's called a W-4 form. That it tells us about your withholdings. It also tells us based off of your withholdings table. You select your number of dependents based off of that table, and you fill that out on your W-4. Then that information gets entered into the record, and at the end of each year, you'll receive a W-2 form from your employer, which tells us your annual earnings. Okay, and that's what you use to file your taxes with is the W-2 form. If you are like an independent person, meaning you file your tax return quarterly, you'll receive a 940 or a 941 form. The 941 form is a quarterly filing that your employer does. Uh, Let me see here. And then the payroll records, these are really just internal type of stuff. So a payroll register tracks all the payments made to employees. Payroll checks, this is what's issued out to the employees, the pay stubs that would be considered part of the payroll checks. And then an employee earnings report. This is a record of all of your pay stubs that you've received since the time you've been employed. So just good to know. Just good to know stuff. Lastly, I want to talk very briefly about corporate income tax. So, in addition, obviously, to the taxes that you have to pay, your company also has to pay taxes on a regular basis, and we call these corporate income taxes. Now, corporate income taxes are very commonly paid off of the the bottom line of the company. So based off of the net income or net loss in some cases. Um, well, I mean, what I mean to say is technically that the amount of tax that the company pays is based off of their operating income or operating loss in some cases. So we take the company's tax rate, which in the United States, I believe the corporate tax rate is 21%, I want to say. It might be lower than that now. I'm not too sure. Last I knew it was 21%. And so we would take that rate, 21%, multiply that by whatever the company's operating income is, and that'll give us the amount that the company should be paying in income tax. Companies are required to pay their income tax on a quarterly basis. So every 3 months they pay their income tax. So the way that they do that is they debit income tax expense and credit income tax payable for each month, and then at the end of the quarter they debit income tax payable and credit cash. And that's the way it works. Very, very simple, very straightforward. Are there any comments, questions, or concerns that you have about anything we talked about today or anything in the class in general that I could help to answer for you? Anything at all. It's open mic night, so whatever you want to talk about is fine. Anything at all. Any questions, comments, concerns?
Not from me, Professor.
All right, Kia, fair enough. Fair enough. Great.
I have a quick question.
Hannah, yeah, what's
Um,
up?
but not in regards to the lecture. Since next week is a holiday and we would normally meet on Tuesday since we met on Thursday today, are we switching class to Thursday next week or just not having it in general?
Yes, yeah, we will switch. Thank you so much, Hannah, for reminding me. You're right. So Veterans Day is on the 11th. Um, we will have class on the 13th in that case. So plan on meeting next Thursday in this case. We are closed on Veterans Day, right? We're
Yeah, the whole university is going to be closed.
okay. I just want to make sure because I know some institutions they stay open, but yeah, okay. So in that case, we will hold class on November 13. So next Thursday, plan on meeting on Zoom. Great question. Thank you so much for that reminder.
Of course.
Cool. Anything else? Any other comments, questions, concerns? Okay. Well, thank you all so very much for your time today. I really do appreciate being with all of you as always. And again, apologies for the last week or so. I've been away for a conference and some other stuff I had to take care of, but I'm glad to be back and be back with all of you. So thank you all so very much for your time today. Appreciate all of you. And I hope you have a wonderful rest of your night, a great weekend ahead, and I plan to look forward to seeing you all again on Thursday next week. Thank you so much. Have a good one.
Thank you, Professor.
My pleasure. Take care. Good night,
You
y'all.
too.
All right, bye-bye. Take care. Bye-bye.